Every year, the IRS drops a new number, the IRS standard mileage rate. And for a lot of people, it kind of just exists. You're told, reimburse at this rate, or deduct mileage using this rate. But where does it actually come from? Is it arbitrary? Is someone at the IRS just guessing? Short answer, no. Long answer, let's break it down. At its core, the IRS standard mileage rate is meant to represent the average cost of operating a vehicle for business use. Not just gas, everything it costs to put miles on a car. The IRS uses this rate so individuals and businesses don't have to track every single receipt just to deduct or reimburse mileage. It's a simplification, but is based on real vehicle data, not a made-up number. The IRS looks at several real-world vehicle costs when setting the standard mileage rate. Fuel is the obvious one and the most volatile, but the biggest component year over year is actually depreciation. How much value a vehicle loses as you drive it. Then you've got insurance, maintenance, repairs, tires, oil changes, all the boring but very real stuff that adds up. The rate is essentially an average of what it costs Americans to drive 1 mile. This is why the IRS standard mileage rate changes almost every year. When vehicle prices rise, when insurance gets more expensive, when gas spikes, the rate usually follows. And historically, if you zoom out over the last few decades, most year the rate has gone up, not down. That's not a coincidence. It's because in a normal US economy, costs tend to rise over time. Some years inflation is higher and the rate jumps noticeably. Other years, costs stabilize and the rate barely moves, or occasionally even dips. But overall, the mileage rate is reacting to real-world vehicle costs and long-term inflation trends, not policy decisions or guesswork. For employees and self-employed drivers, the IRS standard mileage rate determines how much mileage you can deduct tax-free. For employers, it sets the maximum tax-free reimbursement under an accountable plan. If you reimburse at or below the IRS rate, you and your drivers will be subject to no income tax, no payroll tax. Go above it, that extra amount can become taxable income. That's why this number matters so much for finance, HR, and anyone running a mileage reimbursement program. So while the IRS standard mileage rate looks like a simple cents per mile number, there's a lot baked into it. It reflects real driving costs, real economic conditions, and real trade-offs, all boiled down into one benchmark. If your business reimburses employees for driving, or you track mileage for taxes, understanding how this rate works helps you make better decisions. If you want more breakdowns like this, or help choosing between CPM, favor, or other reimbursement options, check out our other videos and subscribe. Thanks for watching.